Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Back in the studio again today with all kinds of new economic data that has been released and more to come. Very excited. Ezra, it could be a golf day though, to be honest with you. 70 degrees. I'm wearing short sleeve shirt. And what is it? February 23rd?
Yeah, we're definitely about 5 weeks before when that happens here in this part of the country. Yeah. It's odd. Of course, the saying for the Ohio Valley goes, if you don't like the weather, wait 5 minutes.
Yeah.
So that doesn't mean it won't snow 5 inches next week. We don't know.
It's like 40-something tomorrow is what I saw.
Yeah.
And I think it's going to stay cold for a little bit. But, 70-some degrees here in Cincinnati, Northern Kentucky in late February is awesome.
Yeah, it has happened before. It's not something where you're like, oh my gosh. It seems like every year we get one of those like major storms prior to Christmas. Like whenever that happens, remember when it was like -5 and it snowed and iced? Seems like every year that happens, the end of the winter usually ends up milding out.
Yeah.
Whereas when we kind of save it all up, February is what sucks.
Yeah, it's kind of like the beginning of the stock market. Like we
see where I was going with that?
I saw that. Awesome start in January, cooled off in February. Basically, January was borrowing some of February's gains. Mm-hmm. Has not changed our outlook here at all. So if you're new to the show, welcome. Thanks for checking us out. If you like what you hear, don't forget to give us a like, subscribe, hit the little notification button. That way, when we drop these every 2 weeks, you'll get notified that there's a new episode for you to check out. And certainly don't be shy about leaving comments. We've got a lot of really good feedback. Whole point of the show is just to give you guys some information as to what is actually going on right now, which I know you can turn on the news and see all that. But one thing that we feel very strongly about is the news does a poor job of providing historical context around events that are going on right now. And when you can apply what's going on right now to what history has to say, you can now begin to formulate, a game plan for how you're going to position yourself. Because the one thing that we know for sure, thanks to Warren Buffett, is that human beings, they just do not learn from history.
Never.
And, it's kind of evident. We've all been around for 2,000 plus years, and I don't think the human beings changed all that much. We've just gotten cooler things like technology to help us be a little more efficient and get places faster and so on and so forth. But that's the reason why we do the show. Let you know what's going on, give some historical context, and talk about how we're positioning to take advantage of what's coming down the pike. So welcome to the show for those that are new. Welcome. Thanks for those that are returning. And you can always hit us up, too, with your questions via text on 513-630-2664. So we got some new data that just came out. And we'll start with the Federal Open Market Committee meeting minutes. That was February's meeting, right? So they had their meeting, they raised the interest rates by 0.25%, and a couple weeks later now, we get their, little minute report, essentially like what was the conversation about, who said what, and essentially everybody kind of agreed that interest rates need to go up a little bit more to combat inflation. What they're also saying though is, and this is what was kind of bullish from the minutes report, is that they don't see a need to go crazy with increasing rates. They're probably for sure going to do another 25 basis points here in March. They're talking about doing another 25 in June, the following meeting, after March's meeting. But that may or may not happen. So they're basically talking about slowing the pace of increasing rates.
Yeah. And
they're all starting to acknowledge the fact that they're seeing some disinflation. Powell said that 13 times in his February 1st, announcement.
Right.
That was scheduled. So they're starting to admit to some of that, so that's been good. However, the labor market is still exceptionally strong. So we got a new labor data report this morning, and the initial jobless claims actually went down. So we were expecting 197,000 jobless claims. We got 192. That's a good thing, in my view. I'm not going to, boo-hoo that one. I know the Fed wants more people to not have a job right now to, in their words, slow down demand. But that's just not going to happen. I don't know what you see as. You're out in Louisville all the time, but I know for sure here in Cincinnati, I got a lot of different types of business owner clients and all, manufacturing, services, internet-based businesses, et cetera. And they all just cannot get enough good employees.
Yeah.
And they just won't let them go. because they just have to rehire them, a quarter or two down the line. So they're just like, I'm not letting go of talent. I'm going to train them up. I might even still try to hire other people just in case this person decides to leave and go somewhere else for, 7% raise.
Right. Yeah. My experience with everything is each scenario has gotten worse/better depending on your perspective, right? Your jobs, your job sectors like retail, service industry, places that just do not pay a living wage. They don't want to rely on minimum wage workers. They're seeing an inability to keep people just for the sheer fact that no one can survive on that kind of money. And for whatever reason, those companies, corporations, businesses are not adapting to the new landscape of the employer. Whereas on the other side, you're seeing companies that do recognize the need to keep and retain talent and that they have to be competitive. You're basically seeing those jobs always full, right?
Yeah. And you're seeing the announcements for tech layoffs, but the reality is, these people, these engineers or whatever they're doing, they're working for Twitter and Google and, Apple and everybody else. Yeah, they're layoffs, but they're all getting another job like almost immediately. I think the average person in the tech industry is finding another job within 8 weeks.
The friends of mine that I have that are, engineers, like you said, software developers. Yeah, that's not, in fact, some of them have even begun looking for other jobs just to improve their situation, not because they needed one.
And we talked about this months ago. If you don't believe me, go check out the last, several podcasts. So this is not the first time in history we've had a quote unquote labor shortage.
Right.
And I think that this is why I love doing the show. This is why I love my job. This is stuff that people don't talk about. I haven't heard anybody talk about it. But if you actually look at data, history, and I got this information from Tom Lee's team at Fundstrat. So that is one group of people that actually does go back and look at history. I'm sure that there's others, but they do it pretty consistently, and it's awesome. And I talked about this in a newsletter for clients when I've done the quarterly reviews from Q4, beginning in January. We talked about all this stuff. So go check out some previous podcasts if you don't believe what I'm about to say. In that back in the 60s and even parts of the 70s, even smaller parts of the 80s and 90s, we've had labor shortage. And what did corporate America do? Well, if you can't clone people, at least not legally, and you can't pass immigration laws, then your only choice is to figure out a way to automate that task. And you're either going to automate it through artificial intelligence, which is the buzzword
right
that's began this year, and we're even hearing about it now thanks to NVIDIA's awesome quarterly earnings report. Which
20 years ago, the buzz moving retail online. Everything's going online. Everybody's freaking out about that. Remember?
Yeah, I do. And I bet a lot of people would have loved to have bought Amazon right around that time too that didn't.
Yeah.
Or those that did sold it after they had a 2001 issue like everybody else in the space. But that's a different conversation for a different day. Okay? So history...
Non-golf day conversation.
History showed us that corporate America was just going to spend the money on automation, and that's the reason why we're sitting here today, where technology as a sector is almost 25% of the whole stock market, by far and away the largest sector. That trend is not going anywhere. I mean, again, you hear the word artificial intelligence every time you turn on the TV right now.
Yeah.
That is the new buzzword. That is not going to change. It's only going to grow and grow and grow and be a bigger and bigger part of our overall economy, not just here in the United States, but around the world. So getting off of that note, gross domestic production, GDP, came down just a little bit. It was revised from Q4. So we were at 2.9%. They revised that down to 2.7, but still, very, very strong. And then tomorrow, set your alarm clocks, folks. 8:30 in the morning, we get all the inflation data that you can possibly ask for. You got core PCE, CPI. You picked your alphabet soup here. It's coming tomorrow.
Set the phasers for stun on that one. It's going to be a big day.
And then in the afternoon, all the Fed heads start to talk. Not Jerome Powell, but some of these members are voting members. Some of them are not voting members, and they're basically just going to tell you their own personal thoughts about inflation and interest rates and so on and so forth. So buckle up. It could be a really awesome Friday leading into the weekend, which I think it will be.
Yeah.
We got core PCE index. The analysts are expecting a showing of 0.5. I think we're going to get something a little lower than that, maybe in the 0.4, 0.3 range, which would be awesome. And then, of course, in that afternoon, again, the Fed heads are going to start talking. So even if we get a really good inflation report at 8:30 in the morning before the market opens, it could possibly crumble on itself, depending on what these Fed heads have to say. And that happened to me in December last year. We had the same day, we had an inflation report, and then that afternoon, Jerome Powell's announcement on
he kind of ruined it.
And I'm super excited. Market's up 4+%.
Yeah.
Pre-market. I get the kind of inflation report that I was finally expecting based on data, and positioned accordingly, and specifically technology. And Jerome Powell just kicked everyone right in the shorts.
Yeah, we were all cracking cold ones, and that turned into sad liquor real fast.
It really did. It really did. It was crazy. So I learned a little bit of a lesson from that. But I do expect a good inflation report, which should be a nice little catalyst for the market. Speaking of, we're still kind of wrapping up earnings season as well, and pulling up the data that we have here. So we do have 60 companies reporting this week. So we got about 440 companies that have reported thus far, which is about 88%, of the S&P 500. And right now, overall earnings results are beating estimates by a median of 5%, and 69% of those reporting are beating estimates on the bottom line as well. So it's not bad. It's not great. It's not like the best percentages of all time when you're looking at just the S&P 500, but it's certainly a lot better than what most analysts had expected coming into this year. Everybody was calling, like the consensus call, number one was we're going to have a recession in 2023. If that was true, that was the most obvious and predictable recession in the history of mankind. And by the way, it hasn't happened. I think you got your recession last year.
Right. Yeah. You've talked about that on, with all the data, all the evidence, and many podcasts throughout the past 12 months. Was it you just couldn't officially call it one because employment was so high?
Employment was so low, right? You got unemployment rates at 70-year lows, 50, 70-year lows. And we're still there right now, 3.4% unemployment rate.
And that's the only box that you couldn't check to say this is an official on-paper recession.
Right, because
certainly felt like one to me all year.
Yeah, you lose 20% in the S&P and you get 2 consecutive quarters of negative GDP. That's the textbook recession, other than the fact that everybody that wanted a job had a job.
Right.
Now, why did we not have a recession? Well, if people still have money in their pocket, even though you have elevated costs due to inflation, first of all, an inflation that wasn't the new normal. We're seeing that right now. We peaked out at 9.1% inflation in the summertime of last year, and we're already, getting ready to be below 4.5%. Mm-hmm. By my math, that we've already reduced inflation by half or more, and we'll find out more tomorrow. When we get this print report here. But if everybody still has a job, even with elevated prices came down. Gasoline came down. It didn't come back down to where it was pre-pandemic, where we're all paying less than $2 a gallon.
Yeah, no. I don't know. Well, I don't know where you're buying your gas, dog. But.
Independence, Kentucky, y'all.
So when you say everybody had money in their pocket, you mean just for the fact that there weren't like everyone still was employed, not that we were getting stimulus.
They did get wage increases. It didn't keep up with inflation.
Some people did.
Many
folks I know
job
did
switchers
not.
Definitely did. So if you had a solid job in a solid industry,
that's more the exception than the common experience.
For sure. And it's not the masses, I'll say that. But the masses did also get stimulus, right?
Not last year,
but in 2022, post-pandemic, some people
that
got more than others.
Was so low. I don't even think. I mean, like we've talked about this before. My experience, I
didn't get much. I got like $100.
I got the most anyone could get, and it wasn't even enough to pay for 2 months of my life. So I don't know anybody who benefited from a stimulus that actually had that left over a year later.
I think a lot of it was the small businesses. So there's
sure.
I don't know I used to know the statistic off the top of my head, but the PPI loans, that was a big stimulus. Now, completely different conversation as to how that money got used.
Sure, yeah,
of course, all that sort of stuff. But
it's more common the worker, not the business owner.
Right.
There's way more of that. And yeah, I mean, just like we've talked about the lag effect too, we're seeing, I'm definitely seeing, again, for those of you listening, this is in my sphere. Okay. So I'm not in any way knowing what's going on where you live, but I bought groceries last night. Eggs are already $1 cheaper. I bought gas on the way up here to get to the studio. And the one place that I know in between my house and the studio that has the cheapest gas, it was $1.93 cheaper today than it was in August of last year. So
there you go.
it's already starting to see it come down. Now, like you said, you mentioned, it's not pre-pandemic or not. It's not pre-2022 recession, if that's what you want to call it, prices.
Yeah, I think.
I think we're starting to see it. For me, at least, I am finally trickle into my actual life.
I think that the consensus was we're going to have a recession in the first half of 2023, and the stock market is going to be terrible. The exact opposite has been true.
Yeah.
Okay. Now, that's a good lesson for everybody to kind of take away here is when all, or what feels like all the market or all the economists or all the Fed heads are on one side of the boat, get ready for that to shift very, very quickly to the other side where nobody's positioned correctly. And that's what we're trying to take advantage of right now. And I'm about to rattle off some pretty cool data here.
Love it. Big data energy.
This is what we do. And again, I cannot wait to do one of these podcast shows without talking about the Fed and interest rates. That'll be a good day.
2024 is looking to be a good year.
Well, that's going to be a election year, so I know exactly what we're going to be talking about. And by the way, history would have to say the third year of a president's term leading into another election year. This is generally the best time to be a long-term equity holder. Now, right now, markets are reflecting a feeling of the Fed's still going to set to hike rates. And that means it should be a risk-off signal, meaning that equities, specifically the tech sector, should perform poorly. However, here's your data.
Let's do it.
Since 1970, of the 14 Fed hiking cycles, only 3 of those cycles saw equities fall as Fed was raising rates. So yes, 3 cycles of higher Fed funds equaled falling stocks. So again, there were 14 Fed hiking cycles since 1970. 3 of them saw equities fall, and that was in 1973, 1974 when Fed Chairman Burns was in place. Burns also jacked it up again, 1976 to 1978, and then Jerome Powell, which is 2022 to now. However, stocks did rise 11 other times. And that meant 78% of the time, even when the Fed was increasing interest rates, stocks were rising. Moreover, Fed Chair Burns back in the 70s was trying to stamp out inflation in a hurry, similar to what we're going through right now. Like, let's raise rates as fast as possible and hold them up there to squash inflation. This is exactly what Powell's playbook has been. But what about Paul Volcker? And that's the Fed chairman that increased rates to 20% back in the early 80s to squash inflation.
Yeah.
And that Volcker wrote a book, and Jerome Powell's got it on his desk. And I know that he's repeated the mantra. The title of that book is "Keep at It." Right? That was his freaking
stay the course.
Yeah, that was his freaking mantra last year after they caused inflation. Which that's again, go check out some other podcasts. I don't want to get off on that tangent right now. However, there was an inflation war. But Paul Volcker was Fed chairman, 1979 to 1982, and they were fighting multiple fronts on inflation. They're trying to keep interest rates down. Obviously, they had an issue with being able to do that. But what people forget is in 1980 and 1982, we had double-digit performance in the stock market. Only in 1981 did we see a decline for equities when we increased rates even faster than when we increased them last year in 2022. So what might surprise most investors in the equities actually compounded 15.6% under Fed Chair Volcker. Right? So if you take the years where he was increasing rates, again, faster than even last year, and 2022 is the second fastest we've ever increased rates. Even when Paul Volcker did what he did, equities compounded 15.6%, which was the best stock market performance of any Fed chairman.
Wow.
Right? Increasing rates at that much, that fast. And even when Fed Chair Miller, and that's the guy that was in between Burns, who jacked it up twice, and Volcker, even that guy was able to produce an average gain in the equity markets of 13% while rates were higher for a longer period of time. So history would tell us that, yes, we can still have double-digit types of performance in things like technology and small caps and the overall market as a whole, even when rates are higher for longer and even if rates are moving upwards. Now, last year, that did not obviously happen. We had rates going up the fastest that we've seen since the 1980s when Paul Volcker was doing what he did to tamp down inflation. And that's the reason why I believe that we had a recession last year in 2022. Unemployment was the only reason why we couldn't officially plant that flag and say this was an official recession. But I do think the recession was last year. And I think that we're likely to see, I think the base case should be the soft landing. And even if we have no landing, that's fine too. What we don't want is the Fed to continue to jack up rates and just break something and say, hey, my bad.
Yeah.
Let's start to cut rates now. Like that's the dumbest thing ever. Let's raise rates till we have to cut them. Like that's a bad playbook.
Yeah.
In my view.
They can't, they can't be that obtuse. They can't be that daft. Like,
yeah, it'd be like saying, I'm gonna go on a diet and I'm just not gonna eat for a month.
Yeah.
Just overdo it until my body internally breaks, and then I got to go, oh, yeah, you might need
That's
some.
right. I need nutrition.
Yeah. All right.
Yeah.
I don't know if that's the same. It's kind of a life or death situation here, but.
Well, I mean, the economy is for many people. You know,
this is my business.
Divide between haves and have-nots is no joke. So.
Yeah. Well, the point is that a tough Fed doesn't mean stocks need to fall at every hint of inflation data prints. Moreover, the Fed is increasingly data dependent more and more these days, as opposed to being reactive. And this means a higher terminal rate is not the death. That's not the death of the stock market. Even if they happen to keep rates right around that 5% number, which most people think that they will, it does not mean the death of stocks. Now, under Fed Chairman Greenspan, so this is, again, we're giving historical data here, right? We're still increasing rates. We're still trying to figure out what's going on with inflation and how that's going to affect the markets. And that's the reason for all this confusion that we're still going through right now. Some companies that report, like NVIDIA yesterday, like the whole thing about the chip space was like, oh, there's just all this glut of inventory and nobody wants to play video games anymore now that they can go out and about around the world.
That is not true.
There's all this, not as much demand from the call center standpoint. And then NVIDIA just absolutely knocked out of the park. They've also pivoted and figured out a way to generate additional revenue through artificial intelligence. And they're essentially the system that artificial intelligence runs on from a chip standpoint. They're almost like a complete monopoly as it relates to artificial intelligence and being able to, implement that. So they crushed it. And whereas other companies have done okay in their earnings after they announce them, the stock price goes down 4, 5, 6%. And it's mostly due to the fact that people, as well as the CEOs, it's not because they didn't perform well on their earnings, revenue, and on their earnings per share. It's that the CEOs and CFOs of these companies weren't able to give the type of forward guidance that Wall Street analysts were expecting. And why would you, right? If you don't really know what the Fed is going to do with interest rates, what the real demand is for China reopening, like all these other news headlines that people would call them headwinds for the stocks, they don't really know, right? So why would I want to make it more difficult for my company's stock price in future earnings that I'm going to have throughout 2023? Why would I want to raise the bar for myself if I don't truly know, what Fed chairman is going to do with interest rates and how that's going to affect demand and supply chains, et cetera, et cetera?
Yeah.
So I wouldn't give myself a higher bar to jump over either. So that's why these CEOs and CFOs are giving very cautious, forward-looking guidance, at least from what I've seen so far. And some, like the NVIDIAs of the world, their forward guidance is very, very strong because of the investments that are going to be made in things like the metaverse and artificial intelligence. Again, we're automating more and more things to make companies, people more efficient, have more abilities to interact with others, not just here in this country, but around the globe. So it's very cool and powerful stuff. Now, if we go back in history, though, we had Fed Chair Greenspan. He embarked on 5 hiking cycles lasting from 12 to 24 months. And 5 of 5 times, the equity prices managed to gain. So just because, I'm just giving you like 3 different examples here of other rate hiking cycle Fed chair men and women, where we've still had exceptionally strong performance in the equity markets. So everybody that's saying, we're going to have this massive recession, sell-off in stocks, I just don't see it. I don't know where it's going to come from unless we have some sort of black swan event like, bigger war or something like that we just can't predict.
With the way the last half a decade has gone, you can't rule that out, unfortunately. But I agree with you. It's like data would say that we're beginning to come out of things, and unless there's some unprecedented event again, there's no reason to think that won't play itself out.
Yeah, and I had a client actually ask me about that, the whole war thing, would China go after Taiwan, or would it get more of a bigger conflict with Russia and the United States kind of directly butting heads? And the only answer I can give him is really 2 things. One, if the end of the world is going to happen at some point, it's only going to happen one time. So don't bet on it. And even if you do, there's nobody to collect from.
Right.
Number one. Number 2, history would actually suggest, as terrible as it is when you go through conflict, war, those types of things, as bad as it is for loss of human life and all the humanitarian problems, concerns, the heartbreak that goes on with something like that, from an economic standpoint, history would actually say that war actually accelerates growth for a country, mostly on the industrial front, right? You can go back at any point in time in history and say, okay, the war was bad initially, hurt the stock market, but long-term actually kind of rallied things because it made businesses more efficient, making things that would benefit that. You can go back to World War II and beyond, and you'll see the stock reaction to those types of things. So I am not going to live a life of fear. I'm not going to do unnecessarily risky things. That doesn't mean I'm just going to go get a Ducati and start popping wheelies on I-75 around here, but as it relates to something like war and those types of things that can obviously dramatically affect the stock market as well as human life, I'm just not going to live a life of fear like that. So I'm going to position myself as if the world is going to continue to function. And when it doesn't, nobody's going to care anyway how much money you have or don't have.
Yeah, that's just it. Whether you leave the money sitting in the bank under your mattress in liquid cash or you lose in the stock market, if the world ends, none of those things are useful to you.
Exactly.
So you might as well position it because most likely things are going to work out some way or the other.
And speaking of working out, all right, so we've talked about a couple of things this year that we're overweighting for clients. One is technology. We were in front of that before the beginning of the year.
Oh, yeah.
We were right about that going back to October last year. We're overweight small caps, which again is right behind technology from a performance standpoint this far this year. And we're definitely overweighting industrials. So I want to spend a little bit of time talking about industrials here for a second, Ez.
All right.
So if you're wondering if U.S. manufacturing might finally be bottoming, I think that we're starting to see that evidence in the data here. So the S&P 500 Global Fed United States PMI Index came in at 47.8. This is the second month of improvement. Now, if you go back since 1948, industrial stocks saw their best risk reward when PMIs slipped below 50, which is where we're at today. So the PMI is less than 48. The 12-month median return was 18.6% for that sector with a 79% win ratio. So industrials, you would think that we should see a significant slowdown in production for industrials. Yes, that is true to an extent. However, companies like General Motors just reported their earnings. Their earnings were nothing but fantastic. Ford should have had a much better quarter, but they had some supply chain issues that was really, self-inflicted.
Yeah.
And the data that we're seeing here for industrials is very, very encouraging. It's pretty much based on history, bottoming out, going back to 1948 based on similar data. So we are significantly overweighting industrials right now because of what we're seeing here. And just to be a very logical human being, the United States government has already passed the CHIPS Act and infrastructure spending bills, and that money is going to be spent over the next 10 years in this specific space. So the companies that move dirt, build things, probably going to do pretty well, and history would actually argue that that is also going to be correct. And if the PMIs are bottoming, that's the production for manufacturing index, a median return jumps to 32% with a win ratio of 98% of the time. If we can actually, get pretty close to picking the bottom on that one, which obviously is extremely difficult to do. But based on history and what the data is showing right now for that specific sector of the market, you got a pretty good entry point here in our view. So we're looking forward to the rewards that hopefully will come from that based on what history has to say.
As am I.
Yeah. And if we do continue, on the data front here, where did I want to spend some time? Okay. So let's talk about sentiment here for a second, and then I want to get into some recent questions that I've gotten from clients. So there's a lot of reasons that I'm bullish on the year. You can look at the U.S. dollar. You can look at the bond market. You can look at credit spreads. There's a lot of good things to be excited about. You can look at the actual earnings for companies not being nearly as bad as what everybody had anticipated.
Right.
But the other catalyst that I see here is that the institutional investor, which is, your pension funds, your hedge funds. I mean, this is like 73% of the market. So the retail investor, you and I, clients that I do investing for, that's only about 27% of the whole stock market, right? So the big smart money is basically still sitting in cash. And this is what I wanted to share with the audience here. So short-term sentiment is diverging from long-term sentiment. Specifically, this is shown in call option data. So call options trading has recently hit an all-time high in volumes. Furthermore, Bank of America portfolio manager surveys from January of this year showed that portfolio manager allocations to U.S. equities have plummeted to the lowest levels in nearly 2 decades. So if we have 73% of the market not participating in stocks because they're afraid of what the Fed may do with interest rates and how that's going to affect the global economy and how the impact of the rate increases that they've already made will impact the economy, because that's still coming too. That hasn't really significantly shown up in the data. They're exceptionally bearish because of all that uncertainty as it relates to what the Fed's going to do with interest rates and how that's going to affect things, of course, not just here in this country, but also globally. And then you're also seeing a massive uptick in options trading. This is just a way for people to hedge against losses in the market. Or they can sell covered calls. If they think stock prices are going to stay the same or go down, they can generate an additional stream of income by writing a covered call. And that's not going to completely eliminate losses in most cases, but it'll certainly soften the blow. So with all that being said, with all the things that have happened in January, the first 26 trading days, that's a really good omen for what's going to happen throughout the remainder of the year. As January goes, so does the rest of the market, is the typical phrase. We borrowed some of the gains from February, in early January with the great start that we got off to. With the data that we're seeing here, the exceptionally strong labor market, the fact that industrials have not fallen off the cliff and neither have earnings. I don't know what other data points you all need to see to know that this is not going to be the recessionary year. It's just not going to happen. It's probably more likely to be a double-digit performing year for the S&P 500 and maybe in a much better year for the technology and small cap sector. So I am very much excited that we're pretty much fully invested for customers here at Shepherd Wealth Management, because as soon as the rest of the market, which is the bulk of it, sees what we see, then there's a really good probability that you're going to actually, receive that 20+% type of performance that other points in time have also received under very, very similar circumstances, with rates being elevated and potentially the Fed increasing them a little bit more before they begin to look at potentially cutting rates. So I don't think we need to wait around for the Fed to give the all clear signal hey, we're going to start to cut rates. I think that we can already start to look through some of the short-term, news headlines and start to position ourselves accordingly, because I think that this is exactly what's going to happen by the time we get to the summertime and through the rest of 2023. It's just an awesome rise in the equity market. So
that's rad. That's
the data. I don't know what else to give you guys today, but I'm not the bearish person here. So you can get your bearish news from somebody else. Now, I did recently get a couple of questions because of all the uncertainty about annuities, right? So I don't know what happens, but it seems like this happens every time where there's volatility in the market or elevated panic selling, right? We're seeing in the data here, people not being positioned in equities. I always get the question hey, is an annuity a good investment, right? I don't know what these insurance agents are doing. By the way, you guys need a behind the scenes look at the difference between, let's say, an insurance agent and somebody like myself who's a certified financial planner. And let me just break that down for you in 30 seconds.
Let's hear it.
Insurance agent has to pass a 50-question test in the state of Kentucky anyway.
We should do that online. I want to be one.
And as I know that this isn't your thing, you have advanced degrees in art and you can do some cool stuff that my brain's not capable of doing.
Well, vice versa, homie.
Well, yeah, that's just what makes up the world and markets and so forth.
We all have our strengths.
However, you might think, oh man, I don't know the first thing about an annuity other than I get a stream of income from it.
Yeah.
I could get you to pass that test in 5-10 minutes with just me explaining to you the difference between a variable annuity and a fixed annuity. You go past the test.
Well, we should do that online one day on the podcast.
I've taken that twice. The only reason why I don't hold that license anymore is simply because there's just a lot of really bad products out there.
Yeah,
and
we did a podcast about. We did an episode of that, I think, about a year ago.
Yeah, a lot of shady people in that particular industry. So anyway, it's a super easy test to pass. You don't even need a freaking high school diploma to be able to pass this test.
Yeah.
And now you have the ability to make recommendations for people's assets, putting it into something that's backed by a contract from an insurance carrier. That's the process of getting into the insurance world. And by the way, when you make a sale, when you sell me, let's say an annuity, you're going to get an 8% commission. So if I put $100,000 into a product of yours,
$8,000,
you got $8,000 right there. So that's why people in this industry, in this insurance industry that just work on commission, that just sell an insurance product, what do? They have access to all of the products. Most of the time, they're not just, working with Great American Insurance products. They're working with those. They're working with Jackson Life, Allianz. They generally have access to all of them.
Yeah.
Right.
Okay.
So if you're going to get this 8% commission, there are trails too, by the way. We don't want to talk about that. But if you're going to get this 8% commission, what are you going to do? You're going to make announcements. You're going to have meetings. You're going to publicize, hey, afraid of the market? Here's a way to guarantee protection as well as guaranteeing returns. Now, what they do in these dinner meetings that they'll host or individual prospect meetings that they might have, they can run hypotheticals saying, you could say, hey, Casey, if you put $100,000 in this thing and it gets invested in these specific investments, so they're using mutual funds, right, inside of an annuity contract, that's what they're going to be investing in. And assuming that we get the last 10 years market performance, which, by the way, the last 10 years of the market performance is some of the best in history, which is, again, over hyping the particular product, right, because they're using previous 10-year returns. And they might be able to say, hey, we're going to also give you, by putting in $100,000 today, if you can do that before the end of the month here, before the end of February, we'll actually put in another $32,000 for you. It's kind of like a bonus. Well, here's the deal. All that stuff is just a bunch of smoke and mirrors, because the only guarantee in the particular product, and this is a true example, we might be able to have to show like little screenshots of what I'm talking about here, but the annuity is a tool, okay? It's good for certain jobs. So what is an annuity good for? An annuity is good for taking the responsibility off an individual investor to produce a certain stream of income for the rest of their lifetime. So you got one of two choices. You can either build up a nest egg big enough to be able to take a stream of income off of it and make sure that your needs are covered for the rest of your lifetime. Or you can take that liability and put it on the shoulders of an insurance company through the form of an annuity contract.
Okay.
So the only thing that an annuity solves for, its only true purpose, is to provide a guaranteed stream of income. Now, all the other variable components of the annuity, the participation rate, the bonus, the caps that they'll have on it, it's not contractually obligated. They can change any of those things. And remember, they just gave you a hypothetical of what this might look like over the next 25 years based on this information today, which they can change at any time they want to for the life of the contract. And they're not going to make a phone call to you and say, hey, by the way, we're changing all of this stuff that we showed you in this hypothetical. Ugh. So my client was looking at all the smoke and mirror things, saying, hey, Ole, look at this bonus and
free $32,000.
All this stuff. Like, I just get an extra $32,000 for putting this in there. I was like, yeah, well, you're taking money out of this thing in 11 years, right? He was like, yeah. I said, okay. Let's go back to the contract. What are they guaranteeing you? Well, they're guaranteeing you a 4% withdrawal rate of whatever the value of that contract is 11 years later, right? And even if they give you that $32,000 bonus, and even if you get some of the hypothetical things to actually happen, your guaranteed income is 4% of whatever that number is. And in this example, it was like $5,300. I said, okay, $5,300.
In 11 years.
Yeah, you got to wait 11 years, right? And you only can tap 4% of that balance. And if the market goes up from, let's say, that $5,300 number to now a bigger number, yeah, you get to lock that in. Like, that's cool. But you're guaranteeing 4% withdrawal of that value for the rest of your lifetime. And it can't go below $5,300. It can only go up. But that's the only guarantee. You're getting a 4% withdrawal rate on X amount of dollars.
Yeah.
Whereas we were showing him, hey, we have a commission-free product, actually from the exact same carrier, in this instance, Allianz. So why do we use commission-free? Is because I'm a fiduciary. I cannot charge commissions. I can't make commissions off of anything, which is good. That means we can literally use the best possible option for a client.
Yeah.
And it puts more money back into the investor's pocket. So in this example, same carrier, Allianz, same $100,000 investment, no bonus. It is invested in a couple indices through mutual funds, just like the other product. But the guarantee was an 11% withdrawal rate on your money. Now, why did he get a higher guarantee withdrawal rate? Is because we took out the commission, that 8% that agent would have got, and we put it back into the product itself.
Yes.
So even though he wasn't getting the $32,000 bonus, and even though we were using hypotheticals with an average market return of 8.5%, which the S&P average is 10 over a long period of time anyway, but we were, again, being fiduciaries, giving you something realistic. They were showing him like 15% returns, which did actually happen over the last 10 years, but would you expect that to happen consistently decade after decade? Probably not.
Yeah.
So with the exact same product, through the same carrier, investing the same way, using realistic actual, performance figures. This guy was going 11 years out. Instead of getting $5,300 worth of income, it was $11,000 worth of income. And it's because he was focusing on the smoke and mirrors and not what the guarantee was. What was the product designed to do? It was designed to solve a problem, the problem being guaranteeing a stream of income off of a portion of your portfolio.
Right.
So he no longer has to be the person that's responsible for getting that type of income. Could he get more than that in the market? Absolutely. Could he get less than that in the market? Absolutely too. It just depends on how he makes decisions between now and the next 10, 11 years. That's the only thing that annuity product solves for. It takes that risk of him being able to generate that income and putting it on the back of an insurance company through a guarantee. Now, annuities are not all good for everybody. There's a lot of things that I could say about annuities that most people can create their own annuity because they have enough resources. They just don't know how annuities function, behind the scenes like I do. But we were basically able to get this guy a much better solution with just showing him the difference between a commission-based product and a non-commission-based product. And what really struck the chord is the simple example of loaded mutual funds versus non-loaded mutual funds. So back, 15 plus years ago, most investors were investing in mutual funds exclusively, and almost all of them were what they call loaded funds, meaning that you paid a commission up front to buy, whatever PIMCO's fund was. You paid a 5.25% commission, right? So if you put in $100,000, $5,200 went to the advisor that placed you in that in that mutual fund. Today, you can still buy the same commission-based PIMCO mutual fund if you wanted to, but why would you? You can go get the retail one for free.
Yeah,
same thing.
You're just taking the middleman out.
Exactly. So we explained it to him that way, and that's when he got it. He stopped focusing on the smoke and mirrors of the $32,000 bonus and all this other crap that they were putting in there, which again was not contractually, obligated for Allianz. They could change all of that shit anytime they want to. So I say, hey, I could put you in a loaded mutual. I could build a portfolio for you of a bunch of loaded mutual funds. But you would think I'm freaking crazy, right? Because you got 100 times more, non-loaded mutual funds and ETFs and individual stocks that are completely free,
right,
for me to invest in. So why would I do that? When I broke it down for him like that, then he got it. Then it started to make sense for him. So luckily,
you need a fiduciary, folks.
It's exactly right.
You need a fiduciary, folks.
That's
you need
right.
a fiduciary.
That's right. I mean, it's 100% true.
Right.
It's 100% true. I mean, just what I told the client is that what Congress should spend some time on, since they're worrying about regulating everything, including technology and everybody in this industry. How about you worry about the insurance part of this?
Yes.
You go into any major city, the tallest building in the city, I can almost assure you, is an insurance company. Now, that's not the problem. The problem is they always worry about fiduciaries in my industry, making sure I have the disclaimers like past performance is no guarantee of future results. I get audited. They go through freaking everything, including personal, bank, and credit card statements, the whole thing, which I'm totally cool with. Totally cool with it. I wish they would just get done with the audit and then announce how clean.
How awesome you are.
Yeah, how clean and tidy and organized everything is.
Yeah.
That'd be nice. It's not going to happen. That's not my problem here. What they should require anybody to do before they sign up for whatever insurance product, they should require a completely independent third-party certified financial planner to take a look at it with the customer before the actual transaction is official, because at least they would be fully informed. Yeah. Completely informed with an unbiased look at it.
That is the last thing Congress wants is fully informed people. So they're going to continue to audit the good people who are helping and let the villains and the insurance agents just run free.
I'm not saying that they don't audit them and stuff like that, but what I am saying is there's very little due diligence on the investor side. It's more about investor protection.
Yeah.
Yeah, legally, you can show all these not cool, but you can show all these crazy hypothetical examples with an insurance product. And they're just selling what the whole freaking thing is. I keep going back to behavioral finance. We're all hardwired with fear and greed, going back to the beginning of time. And what we've learned from the study of behavioral finance, and this is going back to the freaking 70s. So how this isn't a part of the fiduciary process for an insurance transaction, I don't know. But human beings are hardwired with fear and greed. We feel losses twice as much as we feel good about making money. And as soon as we have something negative in the economy happen, you get all these insurance agents doing exactly what I'm talking about here today, selling to the fear side of the human being, which again, they feel losses twice as much as they feel about gains. And now they're just going to show you these hypotheticals like, hey man, I got guarantees for days. You don't got to worry about anything. And we'll be able to make sure that you have the type of income that you're looking for.
Yeah. Oh, by the way, some of this is mine.
Yeah. And we're not going to disclose to you the fact that a big chunk of what I just described, we can change anytime we want to.
Yeah.
And we don't have to call you about it.
Including as soon as you sign the paper.
And by the way, if you do business here at Shepherd Wealth Management, the biggest packet of data is the ADV, which I'm required to send to everybody every single year. It's just the background of myself and the company and how we're regulated and all this stuff. Nothing even for the client to sign. If you sign up for one of those insurance products that I just described,
yeah.
The packet, what they call prospectus, which shows all the details of the product, what can be changed, what's contractual, what's not. I mean, it's like reading the freaking, Old Testament. It's a lot. It's a lot of information in there. And it's going to take a minute, and nobody reads it. And the insurance company, the insurance agency is completely covered from a legal standpoint, but the investor ends up holding the bag. And what I mean by that is if they wanted to get out, there's something called a surrender penalty, and it's on a scale. It's usually on like a 10+ year scale. So let's use 10 years as an example. And the penalty in year one, so let's say, you bought one of these crummy products and you're like, hey man, this is a
scam.
This is a complete scam. I want out. I want my $100,000 back. Well, you're going to have to pay a 10% fee just to get out. And then it goes down to 9% the next year, 8%, so on and so forth. So you end up getting stuck with this thing for a decade or close to it until you can do something else. So that's my little rant on annuities. I'm not saying they're completely bad 100% of the time. They do serve a purpose. They have a function of solving certain problems for certain individuals.
I mean, even Satan serves a purpose. So let's just, I don't want to make that analogy, but yeah, let's just say Satan.
Yeah. This was why, I don't work in that industry. And when we do use those products, we use non-commission based products through a third party called DPL. And that's the only thing that they do is work with independent third party advisors like myself. They don't sell directly to a customer.
Yeah.
They got to go through me, and we're going to show them a commission free product and show them how much different and better it is, the specific guarantees, not talking about the hype, because the hype is a bunch of BS. So we got through a lot here today, Ed, as I feel like we went over a bunch of data, went over some historical things relative to the data that we've already gotten, what we're about to get more of tomorrow. And I also got a little bit off my chest here regarding annuities, because people are getting, I don't want to say hoodwinked, because I feel like I need to go back to the 50s and 60s to use that word, but
I like it. We should make that part of the the current zeitgeist.
add it to
hoodwinked, bamboozled.
Yeah, there you go. That's exactly what's going on there. So I hope you guys enjoyed the show. This is exactly what we're here to do, is to inform you. I know the news may try to scare you. I will be here to inform you.
That's just it. It's so easy to scare people into doing things they shouldn't be doing.
Exactly. And we love doing it. So don't forget to check us out about every 2 weeks. You can go to shepherdwm.com, which is our website. You can check out any of the old podcasts. There's a link right to our podcast, as well as Spotify. You can read a whole bunch of information about myself and our president, John Ashcroft, who has an office in Pennsylvania. And of course, we'll be back in the studio again in a couple weeks. So don't forget to text us the questions, 513-630-2664. And with that, I hope you guys have a great rest of your week, and we'll see you again in March. Take care.